Folks, ever since COVID, for one reason or another, the world economy just doesn't seem to grow as it did before the pandemic. And don't just take my word for it. Jeremy Grantham says it too. Hello, and welcome back to Tides of Wealth, where you're just one sale away from financial success. Renowned investor Jeremy Grantham, known for foreseeing major market downturns in the past, believes the U.S. stock market is currently hitting record highs and is significantly overvalued. He's previously predicted crashes like the dot-com crash in 2000 and the financial crisis in 2008. Grantham's concern stems from the market's peak levels, suggesting it could be headed towards another significant downturn. He has a history of cautioning about such situations, highlighting potential risks in the market. First of all, there's the tech bubble. The risks of bubbles are never ending. Right now, it seems like we're coming down from the big bubble in 2021, which typically leads to a deflating period. This phase involves questions about declining earnings, profit margins, and potential recession that might extend into the following year. While some say a recession isn't likely, Jeremy disagrees, especially considering the Federal Reserve's track record in predicting these downturns. They tend to miss the mark, especially when it comes to the aftermath of major market bubbles. Regarding inflation, it seems somewhat beyond control at the moment. Jeremy doesn't foresee inflation dropping to the lows we've seen in the past decade. Instead, we might be looking at a stretch of moderately higher inflation and subsequently slightly higher interest rates. Ultimately, the current trend suggests higher rates than what we've experienced over the last decade, impacting asset prices in the process. Interest rates. The stock market has been on a remarkable run for about 15 years, as seen in the S&P 500 index climb from around 1,000 in February 2009 to about 4,500 now. It's been a golden era for investors. However, there are concerns, including those voiced by Jeremy Grantham, about whether this high market can last. A major reason behind this soaring market is the consistently low interest rates in the US over these years, nearly close to zero. Let's break down how interest rates impact the value of assets like stocks, bonds, and real estate, which essentially make money for you. When we assess an asset's value, we consider the future earnings it will generate and bring that back to today's value using an interest rate. This might sound complicated, but think of it this way. Would you rather have $10,000 today or the same amount in 10 years? Most would choose money today because money now is worth more than in the future. This concept is called the time value of money. It's not just about the numbers though. Human behavior also plays a role. Grantham points out that when interest rates are low, people tend to invest more in stocks, which can further drive up their prices. This combination of numbers and behavior helps explain why the stock market has surged in recent years, despite economic ups and downs. Oh, and by the way, if you're enjoying everything so far, we would really appreciate it if you could subscribe to the channel. Human behavior. It seems like the tech bubble that started last year might not be fully finished yet. There's still some of it left to play out. There's even a little mini bubble happening, particularly in artificial intelligence. This time, it's not affecting the overall economy as much as the big tech bubble did in 2021, or back in 1929. But why do people always want to jump into a bubble, even when they know it might burst? Well, it's human nature. When we see the stock market booming, we fear missing out on something big. Even super smart folks, like Sir Isaac Newton, fell for a bubble and lost a lot of money. It's that temptation of seeing others get rich that's just too hard to resist. There's this point where enough people start believing the market will keep going up, and that's when everyone rushes in. Most of the time, the market has a balance between optimists, known as bulls, and skeptics, known as bears. But every once in a while, about every 20 years or so, so many people become super optimistic that they stop thinking about the basics, the fundamentals. That's when the big bubbles form. Bubbles. Bubbles happen because when people see others making loads of money in financial markets, they get scared of missing out. This has been going on for ages. Even J.P. Morgan, a big banker from the early 1900s, knew this well. He noticed markets going up and then crashing repeatedly. He once said that seeing your neighbor get rich messes up your judgment about money. Let's talk about Isaac Newton, the genius behind gravity and the laws of motion. He's known for his brilliance, but even he got caught up in a financial bubble in 1711. Newton put a lot of his money into the South Sea Company, a British firm promising huge profits. At first, he made a ton of money as the company's stock soared, but then he got greedy and borrowed money to buy even more stock. But when the bubble burst in 1720, the company's stock crashed hard. Newton's investments became almost worthless, and he lost a lot of money. He famously said that he could calculate how things move in the sky, but not how crazy people act. So even if a genius like Newton couldn't dodge a bubble, what can we do? Luckily, Grantham has some advice on what to do next. Where to invest. If you're looking to safeguard $100,000 and not take a big risk, Jeremy suggests considering a global index fund. Look for one that primarily invests outside the US. Right now, the overpricing in the market is more of a US thing. Markets elsewhere aren't as significantly overpriced. So focusing your investments internationally could be a smart move for the time being. P/E ratio. Jeremy Grantham believes that there's a significant bubble in the US stock market. One method to gauge if stocks are pricey is by using a P/E ratio, which stands for price to earnings ratio. Simply put, it reflects how much you're paying for every dollar a stock earns. Higher ratios means pricier stocks. Comparing P/E ratios among different countries can give insight. Currently, the US market has a P/E ratio of 22, among the highest globally. India's ratio is almost 24, indicating even higher stock prices. On the other hand, countries like France, Australia, Canada, and Japan have lower ratios, suggesting comparatively cheaper stocks. However, the US hosts numerous massive and profitable companies drawing global investors, which elevates prices. To fully assess it, it's essential to consider the US's P/E ratio historically. Over the last 30 years, the S&P 500's ratio is similar to current levels, indicating a sustained pattern. This leaves room for debate. Is Grantham right about an overvalued US market, or can it persist this way? Well, he does advise practicing caution. Usually, Jeremy Grantham isn't exactly pessimistic. And while optimism can be beneficial during downturns, it can also be harmful in overvalued markets, a sentiment Grantham strongly advocates. He's been warning since 2022 about a potential super bubble, anticipating significant market drops and poor long-term returns. Grantham suggests a potential recession might lead to the S&P 500 falling to at least 3,200 or even as low as 2,200, marking potential sell-offs of around -32 to -53%. Despite these warnings, many investors are optimistic about the US economy and the Federal Reserve's accommodating stance. Grantham attributes our difficulty in recognizing and reacting to market conditions to our inherent optimism, a trait ingrained in us through evolution. He notes that while optimism can benefit businesses and investing, excessive or poorly timed optimism can lead to detrimental outcomes. Research suggests that moderately optimistic individuals tend to make better financial decisions than extreme optimists, who might not exhibit prudent financial habits. Grantham also highlights Wall Street's commercial interests as a reason why many strategists tend to avoid bearish predictions, as negativity can be bad for business. Over the past 2 decades, strategists have often issued overly optimistic price targets, according to reports. He emphasizes that our short-sightedness, a trait rooted in our hunter-gatherer past, might contribute to our struggles in accurately assessing market conditions, focusing more on immediate gains than long-term consequences. So, is an economic downturn expected? Well, the future of the economy is a mixed bag. First, there's good news. The world economy is doing better than expected. The US avoided a recession, and prices are dropping in many places. Not only that, but inflation seems to be under control, with rates dropping significantly from their peak in 2022, and the job market is still strong, with low employment and plenty of open positions. Then there's the bad news. Higher interest rates could cause trouble for the financial markets and some businesses. At the same time, China's economy is slowing down, which could impact global trade and investment. Conflicts in Ukraine and the Middle East are hurting global trade and investment, and food prices are rising, especially for rice, which could lead to inflation issues. Not only that, but the poorest countries are struggling to recover from the pandemic and may lag behind wealthier nations for years to come. Overall, the year ahead looks uncertain, with both good and bad news. The World Bank predicts slow, global growth in 2024, with developing countries facing the toughest challenges. Geopolitical tensions and rising food prices add to the uncertainty. But there's also hope. Increased government efforts and private sector investment could improve the outlook in the long run. Thank you for watching, and let us know in the comments below what you think of what Jeremy Grantham has to say. See you soon.